Joining us now is David Zervos, chief market strategist at Jefferies. So bonds got a bit of a jolt, higher yield, stronger dollar, weaker stocks. Though, yeah. I don't know, I listened to Jay Powell, David, and I thought he sounded extremely dovish. What say you?
So I think Jay was dovish, certainly compared to what we got in the statement and the SEP. And I think he tried to temper the SEP, Sarah. He tried to say, look, it's good news. The dot plot. That it's good news. People see the conditions that would get us to a point where we would think about tapering or liftoff as happening a bit sooner, and that means that people are more optimistic on the economic outcome. They're feeling good about this economy. So I think everything he said, even when it came to inflation, he was talking about their expectations for many commodity prices are going to be sort of similar to what's just happened in lumber. I think he made that specific analogy. He talked about how people were talking about full employment back in 2012 when he joined the Fed first. And it was another 8 years of adding jobs with very little inflation. In fact, well below target inflation. So I got a lot of very dovish vibes out of Jay's talk and his responses to the questions that were asked.
So give us the read on what to do now with stocks at these elevated prices that have been paying attention to every word on tapering and bonds as well, which are also at elevated prices.
It's been you can't argue with this year, right? We're not even halfway through the year. We're still up, 12%? We were up probably closer to 13 with dividends, but call it somewhere between 12 and 14% for the year. That's a great 6-month run. The 10-year sitting here right around 150. I think whether it goes back to 180 or not, 2%, we can kind of all hope for it a little ways, because actually it probably means, like Jay said, it's just a more optimistic outcome. I don't think there's a really cogent case for this runaway inflation, this Fed that loses control, this sort of return to the 70s. I know a lot of your guests, particularly those that were around trading in the 70s and early 80s, like to talk about that. But it's just not the storyline. We have too many other factors that are important, like weak demographics, like rampant technological advance, like excess debt levels that are just. They were there before COVID, and as Jay said today, they're going to be there after we get out of all this. They'll be here for years, and those were the things that were suppressing prices in the past, and they're going to continue to do that.
So good that you don't envisage that particular scenario, David, but as you said, 12 to 14% return already year to date. Does that mean you're not so bullish on the broader indices for U.S. equities for the rest of the year, or does that support allow you to think that there's going to be another 10% for the rest of the year?
I mean, I had penciled in a kind of 20, and I felt that was a pretty good number. I thought, you could even sell out some covered calls here for the rest of the year at the money in and around these levels and collect 4 or 5% and get pretty close to that. So, I think it's a grind personally. And look, you know me, I love to have a fixed income hedge. I love to buy a levered position in the front end as a hedge to my long S&Ps, which has been my bellwether trade at Jefferies for over a decade. The yields are just, they're too low for me, and they still are too low, so I can't do that. So maybe you sell out some covered calls and you kind of grind into the end of the year. But look, I don't see a runaway 30% year, and so I'm okay with that idea. But I'm certainly not saying I think this market is fully priced. I think there's a lot of great stories out there for why this economy is going to be doing great into the end of this year and the beginning of next year, and why a lot of companies that are in the S&P are just going to have a really good run, and it's going to be good for the consumer too. I think everything's firing pretty well. It's for me, the story that's the most kind of confusing at the moment, and I think is going to confuse a lot of people, is the productivity story and the slowness with which we add jobs back. And I think that's got everybody on their back foot a little bit. I think it's actually a positive story, and I've highlighted that in some client notes by noting that we have higher GDP today than we had pre-pandemic, with 8 million less people working, which is an astounding statistic if you think about it. But it just suggests to me that we did a lot of technological advancing on how to build the goods and services and deliver the goods and services that we do without the same amount of people. So it's going to be a slower grind that way. And in that sense, it's a supply shock. So it's somewhat pushes back on the inflation narrative.
Shepard Smith here. Thanks for watching CNBC on YouTube.